In this week's video, we'll cover new long-term bullish signals, serious intermediate-term concerns, and the importance of having realistic expectations. We've got an incredible amount of material to cover in this week's video. The video has been set up in such a way that you can use the pause button on your video player if we are moving too quickly. Keep in mind, charts are a reflection of human behavior, and human beings tend to act in similar ways during periods of high stress and fear, and that applies to all of the bullet points shown on the screen. This is a chart of the S&P 500 futures just before the weekly jobless claims report was released on Thursday of this week. At the exact same time, the Fed announced 9 additional lending programs, and you can see what the futures did after that announcement. The relevant takeaway here may be this. Before the Fed announcement, it appeared that the market was starting to focus on the weak fundamentals. We were expected to open down on Thursday, and after the Fed announcement, the market's focus went in a different direction in the short term. Has the market been totally irrational relative to the rally that we've seen? No. When the market was falling in a waterfall manner, market participants were worried about the economy, liquidity, credit concerns, and solvency concerns. Actions taken by the Federal Reserve have not eliminated these concerns, but it has greatly reduced concerns relative to liquidity, availability of credit, and solvency going forward. The Fed has addressed 2 of these 3 bullet points. They cannot address the first bullet point. Do employment figures and earnings mean much during this period? The answer is absolutely positively yes. They mean a lot. In a very simple manner, this is pre-coronavirus on the left side of the screen. When we restart, revenues will be lower. Not everybody will get their job back, and profits will be lower for some time. And the longer the economy is shut down, the bigger the hit we will get between pre- and post-virus economic data. That's why weekly jobless claims and earnings over the next few weeks and months will be important. It's giving the market some idea of what the other side might look like. The further economic data weakens in here, the lower the magnitude of this apex that we can expect to see on the other side. And that is a function of time. The longer it goes on, the worse it gets on the right side of the screen. Common sense tells us that many businesses will not be the same when the economy reopens. Thus, the good news for the markets relative to all the Fed announcements in recent weeks is these concerns have been reduced. The bad news for the market going forward. Markets tend to focus on the biggest problem in front of them. Most likely in the coming days and weeks, the market is going to start to focus on the economy and the virus. This is the NYSE McClellan volume oscillator. It is a measure of market breadth. This is a very rare and elevated reading on the right side of the screen, dated April 9th, 2020. Similar readings only seen 1974, 1976, this is the same event, 1982, 2009, 2016, and the present day. Let's look at each case and see what we can learn, starting with 1974. Is October 11th, 1974. If we zoom backwards on this portion here, you can see this is the major low. This is the rally off the low. We get somewhat of a breath thrust. Here's your breath thrust. That's a rare move. And in this instance, the market went back and had a fairly significant retest. From this high, which is right here, the market dropped 13.56%, but then really good things happened. A gain of 51.57% from point A here, October 11th, to this point here. If you feathered in funds during the retest, even better. The gain from here to here was 65.87%. This is October 1974 where my cursor is moving around. This is a headline from this week. S&P 500 caps best week since 1974. In that case, after a few weeks of volatility and a scary retest, really good things happen for a long period of time. Let's shift gears and go to the 1982 case. Similar reading on the McClellan oscillator on August 23rd, 1982. In that case, off of this low back here, the market really never looked back. There was no significant retest, and really, really, really good things happened for a very, very long period of time. This was the beginning of the secular trend that started in 1982 and did not end until the year 2000. Similar situation in the 2009 case. The bottom is back here. We get the breath thrust here on March 18th. And really, really good things happened for a long period of time, with the S&P 500 tacking on an additional 326% in the coming years. 2016 case, the low is back here in February of 2016. This is the date of your breath thrust that's similar to the present day. This is March 4th, 2016. We did see some volatility and a give back here, but it was a great entry point. Good things happened. Chart dated April 9th. It's a weekly chart of the NYSE Advanced Decline Volume line. You can make an argument that this look here, something this significant, was last seen at the major low in 2009. This is the week ending March 13th, 2009. There's your look. This is the present day. Here's a similar look. This is all issues on the NYSE. If you prefer common stock only, a very, very similar and constructive look. Simply telling us to keep an open mind about better than expected outcomes walking forward. We have a lot of data that ties us to 2008. In late 2008, early 2009, NASDAQ stocks greater than the 200-day exponential moving average never could clear this line. We recently cleared it. That's good from a bullish odds perspective. Similar situation here. Everything we said about the last chart applies to this chart. Back to the McClellan volume oscillator dated April 7th. These lines were drawn so we could see if the market could exceed them. If we walked forward to April 9th, we did clear these hurdles here. That's a good sign from a probability perspective. For clients, we have a ton of charts marked up in a similar way to help us assess probabilities walking forward. The front end of this video, we're tending to focus on the good news. S&P 500 bullish percent index, April 9th, 2020. Highest reading ever. We have data going back to 1996. Similar readings, elevated and rare readings, breath thrust type readings occurred after the major low in 2003 and after the major low in 2009. To make an argument, the DAX is trying to make a stand at a logical level. April 2nd, we showed the NASDAQ here with this concerning look. Fast forward 1 week. Looks quite a bit better. Similar situation here. We were below the 200-week moving average. Now we're back above it. Is it all rainbows and butterflies? Absolutely, positively, no. Chart of the 10-year yield, weekly chart going back to calendar year 2002. This is the yield here at the top. This is the 10-week rate of change for the 10-year yield, and the S&P 500 is shown on the bottom of the screen. Notice here, when the market really starts to rally in 2003, and on the other side of the major low that occurs in October of 2002, look where the rate of change is. It's right around the zero line. Similar situation here. In October of 2008, we're way below the zero line. When the market bottoms in 2009, we're up near the zero line. This is what we look like today. Hard to make an argument that this doesn't look more like this before the final low was in relative to this. And here are the numbers. Major low on March 9th, 2009. This rate of change on 10-year yields, this is basically the bond market's way of saying they're much more confident about the future. These numbers in the present day don't say that at all. And in the 2002 case, this number here between this point and this point improved considerably. We really don't have a lot of improvement walking forward 13 trading days in the present day. Where does the 13 trading days come from? We're assuming that this would be a major low. This is a major low and this is a major low. We walked forward 13 trading days because that's where we are on April 9th in these two cases, so we're comparing apples to apples. The bond market doesn't seem that impressed with the current rally at this time. If this chart morphs into a look like this or this, we will learn something. This rate of change analysis is very, very similar to the heat map analysis. We looked at the heat maps extensively on Wednesday evening, April 8th. All of the heat maps. The message is basically the same as the message that we have in the present day on April 9th, 2020 on this chart. These figures tell us to be skeptical that the final low is in. It doesn't mean that the market can't move higher. This just speaks to probabilities. Ratio adjusted McClellan oscillator. This is basically advanced decline. It's not using volume. If you look backwards from this point in 2001, this was the lowest reading in history because we only have data going back to 1998. If you look backwards in 2008, this was the lowest reading in history. Walking backwards, even lower than this reading. Since this is an advanced decline breadth indicator, a reading this low and a reading this low is indicative of serious technical damage. How does the present day compare? We recently had a reading that was lower than the record low reading in 2008 that we just covered, and lower than at the time the record low reading in 2001. This is the look of the indicator on March 12, 2020. Walking forward to the present day, this is unequivocally some form of a breadth thrust here. This is extremely rare. We went from a very, very low reading historically very, very quickly to the second highest reading in history. Second only to this point right here, slightly higher. Therefore, April 9, 2020, similar to January of 2009, March 2020, similar to October 2008, and similar to September 2001. Therefore, it might be helpful to ask, in this case, and this case, which are all similar to this point and this point, had the final low been made in the S&P 500 on September 21st, 2001, October 9th, 2008, and or January 6th, 2009? Answer: no, in all three cases. The S&P 500 dropped an additional 19.57%, 25.65%, and 27.62%, respectively. Simply telling us, history says we should not discount the retest and much lower low case at this time. It is still a possibility based on the facts that we have in hand. Here, historically low reading, very rare, to one of the highest readings in history. Here, historically low reading to one of the highest readings in history. Was it over here? No. We don't bottom until March 9th, 2009, and we bottom from much lower levels. This reading here, and the reading on March 12th, 2020. Indicative of serious technical damage, which typically takes time for that to heal. Talk about maximum flexibility, keeping an open mind. This helps us with the retest lower low case. This reading here says the present day looks better than the 2008-2009 case and helps us keep an open mind about better than expected outcomes and the low is in scenario. The concept shown in red here is also evident in this data. NASDAQ declining TRIX. When it crosses below the zero line, that is a positive signal for the market. Fewer declining issues sounds good. Note, before the major low in 2002, we're way down here. Before the major low in 2009, we're way down here. 2011, down here. 2016, down here. 2018 down here. 2019, second low in 2018, we come down here. This chart stated April 8th. We're still way up here. This chart has some work to do. We're just above 0.25, April 8th. Significant improvement on April 9th? No, we just dropped a little bit. This chart still has work to do. NYSE high-low weekly. Same basic message. Way down here, damage, 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 damage. A lot of damage. After the low, take some time to work it off. You get in the green box. In every single case, you get into the green box. Not quite there yet. Similar situation here. NYSE percent new highs. Serious damage. Serious and rare damage. Very, very serious damage. Not much repair to that damage at this time. April 9th. Some work to do on this chart. In 2009, before the low, we rallied all the way back to this orange line and then dropped a long, long way. Similar theme here. It's somewhat of a mixed bag. Where we are now helps us with this case, but we're not really out of the woods relative to these cases and the potential for a retest of the low. The more this morphs into this, the higher the probability the low is in. NASDAQ advancing issues, TRIX, same theme. Lots of damage down here. When this low is made, you can see the indicators all the way up into the green box. When we make the final low here, we were in the green box here before the low. This tells you that some of the technical damage was being repaired before the final bottom was made, and we're in the green box after the low. We're still way down here in the present day as of April 9th. We'll learn something either way on all of these charts. NYSE weekly, April 9th. Possible resistance. Tech versus bonds, April 9th. Possible resistance. S&P 500 industrials, possible resistance. In all of these cases, we will learn something either way. Sometimes you break right through. Many areas of the market, including leveraged loans, got a big boost from the Fed right after the horrible economic data on Thursday morning. It's a 15-minute chart of BKLN, a leveraged loan ETF. That is strong buying power and a big gap open. Was the enthusiasm held into the close? Absolutely, positively no. This is the full day candle here. That's a scary looking candle. The black tells you that we close below the open. NASDAQ weekly, we said this was potential resistance last week. We've moved back up into the box. Potential resistance April 9th for the S&P 500. NASDAQ April 9th. It's going to be a similar theme for all three major indices. Thus far, we have stalled at the 50% retracement of the entire decline. Doesn't mean we're going to stall. We just prefer to see us get in this area here and stay there. S&P 500, during Thursday's session, we went into the 50% retracement and thus far closed below it. Doesn't really tell us anything about what's going to happen next week. It's just a logical place to wait for more information one way or another. Similar situation with the Dow. Intraday came right up to the 50% retracement, closed below it. This is really not what we want to be seeing here. Economically sensitive home builders, small caps, regional banks. They didn't make it back to the 50% retracement. In all three cases, made it back to the 38.2 or worse. Like to see some improvement in these areas. May happen, hasn't happened yet. If March 23rd, 2020 was the major low, it happened 13 trading days ago. It's a very, very rare 13 trading day rate of change on the Dow Jones Industrial Average. It's only happened 3 times, including the present day, so 2 previous times in the past 100 years. It's somewhat of a good news, bad news scenario if we zoom in on this area here. The good news It was a major low. We never revisited this low or went below it, but after the move off of that low, we had a painful retest of the low, dropping 37.25% from point B to point C, simply telling us to keep an open mind about the low being in and or a retest coming sometime in the coming months. And after this retest, really good things happened. And this does a nice job of summing up a lot of the information. This, in the long run, is very bullish. But in the short run, it was still very volatile and very difficult. The data that we just covered seems to mesh up very nicely with the title. S&P 500 daily going back to the year 2000. Bottoming process, it takes some time. Bottoming process, it takes some time. Notice in the 1932 to 1933 case, we get 2 spikes here during the bottoming process. That's all the way back in the 1930s. Said earlier that humans tend to act in similar ways during periods of high stress and fear. Still human beings in here. Still human beings in here, just as there were human beings in the 1930s. Bottoming process, 2 big spikes in the rate of change. Bottoming process, 2 big spikes in the rate of change. We have 1 big spike so far. What happened in these cases? This helps us with the answer to this question. Does a big and sharp move off of a low, a confident move, mean the final low absolutely positively has to be in? I think the answer is absolutely positively no. You would have felt the exact same way here at point B. The low has to be in. Exact same way here at point B. The low absolutely positively has to be in. Was the low in when we only had 1 spike here, 1 spike here? You can see the answer is no. The second spike comes, and the second spike comes, and the move from B to C and the move to B to C was gut-wrenching and painful in both cases, and in both cases, the low was not in after the big move here. The low was not in after the big move here. We made a lower low weeks later, made a lower low weeks later. Is it possible we're going to get a low with 1 spike? Absolutely, positively, yes, it's possible. And these cases tell us that it's also quite possible historically that we're not done yet. Humans tend to act in similar ways. Lots of major lows on the screen here. Rate of change for the S&P 500. See lots of 2 spike instances. In the present day, we have 1 spike. Simply speaks to probabilities. Back to the potential resistance theme, NYSE Composite Weekly, April 9th. Gold in isolation hanging in there for now, not much change. Still have support down here, potential or possible support. Gold still holding its breakout versus the S&P 500 on a daily chart. Full session after the Fed announcement on Thursday, April 9th. Hard to say this looks like full bore risk on when semiconductors finished down 2.36% and well off the session high. It's quite possible this figure here speaks to the concept that we covered in last week's video. A chart from last week, April 2nd, 2020, institutional stocks widely held versus the S&P 500. We said it was possible that in the last phase, the last sell-off phase, that this might start underperforming rather than outperforming. What happened over the past week? It's been underperforming. When it started to underperform in 2008, was it over? No, it was not over. Here's the S&P 500 here. This is a counter trend move. The low came from much lower levels and months later. No extrapolation, no forecasting, no assumptions. Covered this chart last week. This week it's somewhat of a mixed bag. We're moving in the right direction, but we still haven't retaken these lines here. We'll learn something either way. If you're a bull, this is what you want to see. You want to see this, and you want to see this. April 9th tells us to be open to the low is already in place scenario. This speaks to the potential resistance scenario. Several areas of potential resistance here on this ratio chart. And it still seems very, very hard to believe that this whole thing's going to end without these gaps being filled. The market will make that call. You can pause your video player to read the little blurb on the screen. We may get a breath thrust on Monday. That is to be determined. We've covered numerous looks in the present day, April 9th, that tell us it may not be over yet. Numerous looks based on hard data in the present day. April 9th data picked January 6th. March 12th data chose October 9th, 2008, and September 21st, 2001. We did not choose this date. We did not arbitrarily focus on this period nor this period. In all three cases, lower lows were ahead and additional pain. We're all human beings, and we have to make sure that we're not in a situation where we focus in on the data that makes us feel better. We try to look at all of the data that we have in hand, including the data presented in this week's video, objectively, and thus, our basic take has not changed since this post on April 7th. You can Google our last name, the name of our blog, Short Takes, and Market Scenarios, and you should be able to find that post. A post that was created for CCM clients. Another relevant data point. In this post, we cover a weekly RSI study. In every single case, after the first rally, the market retested the low. Hypothetical targets here based on history. Sometimes you make a higher low, sometimes you make a lower low. In the 2008 case, you make a much lower low. Present day, something that just happened recently, is tied to all 6 of these periods. We've already shown that a big rally viewed in isolation doesn't necessarily mean the low is in. And that speaks to the magnitude of the rally, a big rally. How about the duration of the rally? These are the 6 similar periods that are tied to the present day based on something that just happened. In each case, there was a move off the low. How long did it last relative to what we've seen in 2020? Average number of calendar days for the counter trend rally off the first low was 21 calendar days. A 21 calendar day rally off of the recent low, March 23rd, says hypothetically that the S&P 500 would peak on April 13th, 2020. That, of course, is for the market to decide in 2020 and falls into the to-be-determined category. You can pause your video player, the million-dollar question. So how does this end? And potentially, when does it end would be the $2 million question. Is it possible that we will get through the first wave and there will be a second wave in the United States? Singapore says yes. The damage to the economy is going to be significant. And a disinflationary shock can be difficult to recover from. It's very, very possible the virus could be around for a long time. And with the Fed putting numerous concerns into the back seat for now, it's very, very possible in the coming days and weeks that the market is going to focus on the issues here on your screen. How about the oil market? You can pause your video player. I think it's probably fair to say that the market will be taking it day by day relative to this topic and relative to this topic. Based on everything we've covered in the video, it might be easy to get depressed or discouraged. History tells us that on the other side of this, some really good opportunities are most likely going to present themselves. And if we want to get to the other side, our objective has to be to find the true message from the market rather than the message that we want to hear. And the only way that we can do that, and the only way that we can respect all 4 of these scenarios, is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.